Hey guys, so in this video I'm going to show you exactly how I caught the top of the gold market yesterday to the pip and closed 500 pips profit. Super simple concept, simple strategy. You're going to be surprised how easy this really is. Okay, so if you've watched any of my other videos, you'll know that I trade basic supply and demand concepts. Now, what is supply and demand? Well, if the market is rallying to the upside, like so, candle after candle is printing bullish price action, what I'm looking for is I'm looking for an area of supply to form. Now, what does that look like? Well, it usually looks like a candle with more wick than body. What do we mean by this? Well, if we have a big wick on the candle like so, that is an area of supply. That's an area where buyers were pushing price up higher, sellers took over, drove price back down, and then what would happen is we would see the subsequent move to the downside be bearish. So it would be something like this. These candles may have wicks on them, but that's irrelevant. It's the move away from the zone. And that area there would be an area that we would mark off from body to wick as supply. So if hypothetically price pushed a little bit lower and then it made a reversal here, and then it drove back up again, so we saw price drive all the way back up to the upside here into that zone, we would then anticipate a reaction from that level, and we would be looking to sell that level for then price obviously to trade lower again. And that's basic supply and demand concepts, right? So really, really simple. If you don't understand it, then I've got another video on my channel, the first video I made, which is my simple strategy around supply and demand. This, for example, would be an area of demand because there's more wick than body. This would be an area of supply, more wick than body. So yesterday, what happened? Well, on the gold chart, price pushed to the upside quite aggressively. Now, we've been in this strong gold rally for a long time. Price has been trading, creating higher highs, higher lows, higher highs, higher lows, higher highs. But although we're in an uptrend, the price just cannot continue up forever. And one of the ways to identify this, which is really good, is to add a moving average. You can just chuck a moving average on your charts, set it to a 50, a 100 is good as well, but a 50 is a good starting point. And you can see that on the 4-hour time frame, the market is overextended. Now, there is no point in time when a market doesn't mean revert. It will always come back to the average price at some point in time. And that average price could go up over time, obviously. The average price here in this moving average is trading up, so price is gradually getting higher and the average is coming up with it. But we always revert back to the average. There'll be no time when you can go back through this chart and pick a time where we didn't revert back to the average on every single time frame. Now, obviously, price is pushing away from that moving average, creating distance. And I always say that the trend is your friend until it overextends. Well, in this case, we had started to overextend. This thing can't go up forever. Now, if I look to the left and I scroll back, there's nothing to the left. We're creating all-time highs. Gold is at an all-time high. So if I look left for supply levels, there are no supply levels. This area here on the market is the very top of the market. So we've never been this high before. So I need to drop down the time frames to start trying to reference where we might turn. And you can see what happened here. So yesterday, or the day before yesterday, 8th of October, we formed this candle here and this candle here, and this one in fact. All these candles have more wick than body. So if we go back to our example up here, and we're looking for candles with more wick than body, then we go down to gold here, we can see that we have that. We have a series, in fact, of candles with more wick than body. All those candles there, those three, have more wick than body. And if we really want to refine the zone, then we can take it from the very top candle, because that is the area refined where the sellers took over and drove price to the downside. You can see on the 1 hour, it made a mean reversion. It went back to that 50 moving average. Then price traded back up again. But price traded back up into our area of supply. So this exact zone of supply. Now, if we broke higher, so if price continued above this yesterday and it went up here, I've got nothing to reference to the left. So this for me is the last sell. There's no more sells beyond this level. If we push higher, I'd have to wait for the same thing to form again to potentially take a sell. But what happened was we tapped into the zone. I took a short position on a small rejection, very low time frame. I put a 100-point stop on it, so above the zone here, above the high, and I just simply traded it down on the 4-hour time frame to that last area of structure there. I took the 1 to 5, or 1 to 4 in fact I took off the trade because I closed slightly early, but my target was to take out this low. Now the reason that trade did no drawdown and it worked on the rejection as it came down and price dropped to the downside was also because of market timing. So we were just prior to equities open. This thing was running out of steam. You know, it can't go up forever. It never does. And the market now is creating its mean reversion. It's coming back to the moving average, which it always does. You can even see actually this morning that we've created a structural shift now, and we've come and retested this zone, and we're dropping slightly off that zone now. But I would expect this market now to correct back to the moving average. That doesn't necessarily mean it won't take the highs, because if it needs liquidity and the liquidity is resting above the high, then it might take it. But we're in and out the trade for our small piece of the pie. You know, we don't need to be trading this all the way back to the moving average for huge risk reward. For me, I'm a day trader. I'm just looking at the next area of supply or demand. So on the 4-hour time frame, you could have said that this was the next area of demand. And you can see that price has just traded straight into that next area of demand, driven to the upside. We do have a small one here as well, in fact, which is also sat within that zone, so it kind of overlaps. But you've got two areas of demand there. I usually like to see a change in color with the candle. So for example, this one here is just a bullish candle, bullish candle, bullish candle. Yes, there's more wick than body, but if that candle was a different color, then I would potentially look at that. You also would have had lower time frame demand over here. And if we look on the 1 hour, you would have seen that there was this lower time frame demand here. Again, look, the market tapped in. I was out of the position here at this point and then pulled back, went slightly high. I think actually I came out here just right at the very lows. But you can see again a reaction to that area of demand. It's really simple concepts, but it's all about understanding when to use them, using supply and demand in conjunction with cross-asset analysis. So looking at the market as one entity. Again, something I go over a lot in my mentorship with my students, but it's all about understanding why the market is moving. And if you're still struggling with that, then check out the free resource I've got below this video, which is a way of eliminating some of the losses that you're potentially taking on the pairs you're trading, because you're perhaps looking too much at just one pair rather than, or one asset, rather than looking at the market as kind of one entity, you know, one moving thing, because everything moves in conjunction, everything moves in alignment with each other. And if you look at how gold reacted to this level yesterday, if you go back to any of the other charts, which is the 9th of October at 1 o'clock, so it's the 2 o'clock candle, in fact, 9th of October 2025, you go to any of the other assets, you'll see that the 9th of October 2025 at 2 o'clock, you had a huge sell-off there on the S&P 500. You had a big rally here on the Dixie, so big dollar flow, dollar pushing to the upside, dollar rotation, and then the other assets such as S&P. This was a dollar move, it was dollar driven. Dollar up meant gold down, meant US 500 down, also meant euro US dollar down, also meant pound US dollar down, you know, and that whole market is all those markets are moving together. There's not one market moving on its own here. The dollar is moving every single dollar pair, but it's also moving risk assets, it's also moving equities, it's moving gold, silver, everything. So it's all moving in conjunction. So download the ebook that I've got below this video, and that will help you clarify some of that. And I'll catch you on the next one.